Strategists, meanwhile, rejiggering their year-end S&P targets amid those new record highs and the Fed easing cycle that is now begun. Our next guest is no exception, raising his year-end target to between 66 and 6,800. Also saying, though, he expects volatility to increase some. Joining us now is Cronk, Chief Investment Officer for Wealth and Investment Management at Wells Fargo. Darryl, good to see you. Obviously, the market, it kind of got what it both expected and was hoping for, right? So you have the Fed tilted lower in rates at a time when, in general, the economy is hanging in there. How much is left to capitalize on that dynamic?
Well, actually, you raise a good point. I think a little bit this year, to be honest, Mike, but we think 2026 probably sets up to be an even better year for all the reasons that, you now have kind of the fiscal plane landed, if you will, with the one big beautiful law, no longer bill, right? So fiscal's kind of solved. If monetary policy continues down this path, right, corporate balance sheets are in an incredibly strong position. I mean, just look at the post-Fed. I mean, three things I looked at this morning, Mike. High yield spreads are at fresh lows this morning. There's only been a couple times in history where the Fed has cut interest rates and yet banks are at their all-time high. Usually banks would be sniffing out, through lower credit quality or delinquencies, defaults, if something like that were happening. If the Fed has to cut interest rates in a cutting cycle, that's not happening. And even this morning, equal-weighted tech actually finally set a new all-time high coming off of when it tried to do it in the summer of 2024. So the markets are telling you, hey, things are a go for the remainder of this year and into next year on more of this bull.
What parts of the market, then, do you think are better positioned here? I know that we were just talking about small caps. It feels like you are not quite in the camp that says that's the preferred vehicle.
No, we're not. I mean, small caps, there's two regimes small caps should do well, right? If you think about it historically. One is coming out of a recession as the early leader of the cycle recovery. And two is when you get a steep, or aggressive Fed cutting cycle. And the latter is what we're getting right now. So it doesn't surprise us that you see near-term outperformance of smalls. But when you actually get into the Russell 2000, I mean, today it's a $3 trillion market cap indice against a $67 trillion U.S. stock market cap. Even if you compare that to tech, which is now $28 trillion, this whole idea that you're going to rotate from tech to small cap or something like that is, to us, a little bit nonsensical. And what's more important is the quality degradation that's happened in the small cap universe. Private capital's come in there and cherry picked a lot of the good companies and taken them back private. You've got almost sitting on top of record non-earners in the small cap. So we would fade kind of some of the recent strength here. In fact, we just went to an unfavorable or underweight small caps here about a month or so ago, and we think that's still the right trade to hold.